Good morning, I'm Clinton Griffiths. Grain markets continuing to slide on Thursday on an improving weather outlook and recession concerns. Traders piling in, pushing the December corn futures contract down more than 30 cents, and November soybeans were off 60 at one point. Both markets at their lowest point since April. Wheat was also down about a quarter. But it wasn't just grain futures. Cotton dropped anywhere from $4.50 to $7 per hundred. Lean hogs were down $2 to $3 per hundred, and oil also trading lower during the session. Now, analysts say there was broad market liquidation because world central banks are now raising interest rates.
We've seen the funds starting to step out of the markets here over the last month, and now they've just accelerated that. And we are in a secular bear market, which means we have 10 years of a bull side and 20 years of a bear side. And that started in 2010. It won't end until 2030. And one of the characteristics for the listeners, if they don't understand what that is, it's volatility. It's big moves up and then followed by big moves down. And we've had one of the most bullish moves I've ever seen since about April of 2020, starting in beans, August of 2020 in corn. And I think we're coming to the end of it here. And now we're about ready to drop like a rock from a plane.
While there are macroeconomic issues at play, new forecasts are also easing some concern for crops in the next couple of weeks.
View at the GFS introduced quite a bit more rain for the western, say 2/3 of the Corn Belt, Iowa, Minnesota, Nebraska, the Dakotas. It's not a perfect forecast. There's no such thing. A lot of the eastern Corn Belt still dry through that time frame based on what I've seen in the weather models, at least. Illinois, Indiana, Ohio, places further south, still dry. I think the other factor, in addition to weather, is recession risk. Commodity markets do not perform well during recessions, whether it's crude oil, corn, soybeans, gold, and silver might be your lone exception there, but they don't like recessions.